Hey everyone, so you're probably wondering if there's going to be a real estate crash in 2021. I've actually been having a lot of people ask me this question, so I just wanted to make this quick video to share with you some information that we have so that you can make the right decision for you and your family when it comes to buying or selling in 2021. My name is Rose Gonzalez. I'm with the Gonzalez Real Estate Team, and I'm a realtor in Northern California. So I just wanted to share with you a little bit about why the market is a little bit crazy right now. So one of the reasons is that there's a lack of inventory. We have not as many inventory as we have buyers in the market. So basically, we have less than 6 months inventory in all of California, and actually throughout the United States. We've been seeing a shortage of supply. The reason why we have so many buyers out on the market right now is because the interest rates are still super low. We're still looking at like the 3.3 to 3.5% interest rate right now, whereas 6 months ago we were seeing them below 3% in the high twos. So there's a lot more buyers out there looking for homes because the affordability is higher with the interest rates low. And with that demand, that buyer demand, we don't have enough homes on the market. And partly because some sellers are not sure what's going to happen in the real estate market. The pandemic has also caused an issue with people not wanting to show their homes during the pandemic because of the uncertainty as well. So, supply and demand plays a really big part in why the real estate market is as crazy as it is right now. Another reason why the prices have been going up quite a bit is because of the work from home situation that this pandemic has brought. So for example, in Northern California, we have the tech bubble, which is the Silicon Valley, Mountain View, San Francisco, where we have a lot of tech industries in those areas. And just to give you an example, to even rent a 2-bedroom apartment in Mountain View will probably cost someone about $4,000. And if you are buying a home for, with a loan amount of like $800,000, you're kind of looking at the same mortgage payment. So the people who are now able to work from home that bring in a lot of money from these tech companies are now going to different areas like the Tri-Valley, the Central Valley, you have Solano County, Brentwood, Antioch. So they're going out more in the affordable areas where they can buy a bigger home with more space for their family than they were able to in those major hubs. So I wanted to share a little bit about what the loan options looked like back in the 2006, 2008. That way you can understand where we're going with as far as the housing market right now. Right now, we have very strict loan programs where people have to provide information to the lenders. Whereas back in 2006, 2008, we had loans that were stated income, stated assets. And what that meant was stated income, you didn't have to provide pay stubs or tax returns. You'd basically just write how much money you made on your loan application and how much money you had in the bank, and you did not have to provide documentation or proof. So therefore, the lenders didn't really know if you were really qualified for that home. So I could say I made $5,000 a month, and really I was making $2,500 a month, and my mortgage payments were $2,000 a month. So I really, the buyers didn't really qualify fully for that mortgage payment. So that caused a lot of problems in our lending industry. Another loan program that a lot of buyers really didn't understand back then was the neg-am loans, negative amortization. So all they heard was that there's this program that was 1.25% interest rates. It seemed really low, but what they didn't understand that was that the 1.25% was really not their real interest rate. Their real interest rate was probably like 5-6%. So the difference between the 5-6% and the 1.25% rate was added on top of their loan balance. And we'll go over a scenario to show you what that looked like. But overall, in maybe 5 to 10 years, that 1.25% interest rate will recast, and you'd actually have to pay a fully amortized payment on either your true interest rate, which is 5%, or it can recast to like 6 or whatever percentage the current market is at that time. So people really didn't understand that. And if you're adding to your mortgage loan versus paying it down and gaining equity, when it came time for your loan to cast, you wouldn't be able to refinance if you didn't have equity on your home. So that caused a lot of problems back then as well. So here is an example of what a negative amortization loan looked like. So let's say, for example, you bought a home for $500,000 with 0% down. And back then they were also doing 100% financing. And let's say your interest rate was 1.25% interest only. Your payments is $520. Well, your true interest rate was 5%. And so your payment should have been $2,083. So the difference between the two payments would be added to your loan balance every single month. So let's say, for example, in 5 years, you would have added $125,000 onto your mortgage loan. So instead of paying down $125,000, you're adding that to your loan balance. So now your loan balance is $625,000. So, no property, if your property was not going up in value in those 5 years as quickly as you were adding onto it, you would not have equity. So when your loan recasts and you can't afford your mortgage payment, or you want a lower interest rate, you couldn't refinance because there's no equity there for you. So what happens now is that people go into payment shock. And payment shock is when you have one mortgage payment and your loan recasts and it goes, 2-3 times more than what you can really afford. And so here's an example. So, before you were paying $520 a month. So when your loan goes up to $625,000 in 5 years at 5% interest rate, which is not only interest only anymore. Now you have to pay fully amortized. And what that means is not only are you paying for the 5% interest, but you're also paying for your paying down your loan balance. So you're paying for your principal balance and interest. And so now your payment goes up to $2,600 a month. So now can you see the big difference with, 520 and then 2,600 in 5 years? That was a huge shock for a lot of people, because when they got into this program, they didn't realize what they were getting themselves into. They just saw the 1.25% interest rate. You can refinance in 5 years. And so a lot of people really didn't understand how this program worked, and it caused a lot of people to lose their homes. So right now, just to show you a difference in how things are going with loan guidelines in 2021, actually since we recovered from that 2006-2008 crash, a lot of the lenders took away all of those stated income, stated asset programs, the negative amortization loans, and they became more strict with who can qualify for a loan, because they learned that it was just not the right way to do business. And we really need to make sure these people who are buying homes qualify. And so now when you qualify for a loan, they run your credit, you make sure that you have, a good credit. And they also collect your pay stubs. They collect your bank statements, retirement accounts, and, they make sure that they look at your whole portfolio. They make sure that you have enough money in the bank to cover for all of your down payment, your closing costs, and 3 to 6 months, actually 4 to 6 months reserves. And what that means is that they want to make sure that you have 4 to 6 months of your mortgage payments set inside an account somewhere, whether it's a 401k, stocks, or your bank statements. They want to make sure that you have somewhere to pull from in case you do lose a job for 4 to 6 months, that you have enough money to cover your mortgage. So when it comes to a debt to income ratio, right now, some of the programs, depending on what program you're on, range from 35% to 45%. I know that when you go into like a higher loan amount, like a jumbo loan, your debt to income ratio goes down to like 35, 40. Some of the lower loan amounts, you can go up to about 45%. And what that means is that based on your income, your gross income that is stated on your tax returns and your pay stubs, and it has to be consistent, that you can only use about 35 to 45% of your gross monthly income towards your mortgage payments. And that's mortgage payments, which includes PITI, which is principal, interest, taxes, and insurance. And that's your property taxes and your homeowner's insurance included. So they want to make sure that that covers your mortgage payments and any revolving accounts that you have. And revolving accounts are things that show up on your credit report, like car payments, credit card payments, student loans. The things that don't count on your revolving is, things outside of your credit report, like, phone bills, utility bills, and stuff like that. But, they just want to make sure that you're not going over your head with mortgage payments. So they want to make sure that you really qualify for this loan and that you're not, spending 80% of your salary to mortgage payments, because they want to make sure that you're able to make your payments in case anything happens. So we do foresee more houses coming on the market. We don't know when. The things that are going to bring more houses on the market is more vaccinations. The more people get vaccines, the more they're going to be more comfortable putting their house on the market. Because right now with the pandemic, people walking through your home, things like that, a lot of people have put a hold on that. The end of the mortgage forbearance, as people go back, we start opening up again. People are going back to work. People don't have to put their mortgage payments on hold anymore. And then also the end of the rental moratorium. So right now, there has been a moratorium where landlords cannot evict their tenants, even if they're not paying mortgage, if they've been impacted by the pandemic. So this has been a big concern for a lot of people, a lot of landlords, a lot of people with regards to, are we going to see foreclosures because of these moratoriums? Right now, we don't really know, but what we do know is that a lot of homeowners have a lot of equity in the homes, and as prices continue to go up, more equity is those homeowners have more equity. So once these end, we feel like, there's still a lot of equity in the home, that people who fall behind on their mortgage payments because of the moratoriums or the forbearance, they could still sell their home and still have equity in it. So between the stricter loan guidelines and the equity, I personally don't see a lot of foreclosures happening. We may see some. I'm thinking maybe 1 to 2%. But because there's, people who are purchasing homes right now can't afford to buy them, and people are buying homes that have cash and assets right now. So it's definitely different than before, where, people just really shouldn't have bought these homes. So do we see a crash happening in 2021? If you're waiting to purchase or, make that move and waiting for a crash, I would recommend that if you're in a position to buy, interest rates are still very low right now. If we do see some type of correction in the real estate market, it won't be as drastic as 2006, 2008. If anything, it maybe be like a 10, 15% correction. So if you take a look at this, if there's a 10-15% correction in the prices, but the interest rates go up, 1%, over the long period of time that you own that home, it's going to cost you more money. So with the interest rates being low as they are, and if you can afford it, I wouldn't wait, because the real estate trend, even if it goes down 10-15%, if you hang on to that investment over a number of period of years, you're going to gain equity. So if it goes down, it always comes right back up. So just hang tight to your investments. If there is a correction, and just make the best decision that you can make. If you have any questions on what's happening in the real estate market in Northern California, or actually anywhere in the United States, I have a bunch of real estate friends throughout the United States that can help answer questions outside of California. But definitely reach out to me, comment below on any questions that you have. And if you haven't already, make sure you subscribe to my channel and click on the notification button as well, so that you can see all the videos that we put out every week. So thank you again for tuning in. I hope this was very helpful, and I'll catch you on the next one. Bye.